If you're a trader, you definitely know the feeling. You see a setup that looks absolutely perfect, and then it turns into a sudden, just gut-wrenching loss. Well, today, we're going to break down a really powerful strategy that's designed to help you avoid those exact traps for good. Let's start with a scene that I'm sure is going to feel way too familiar.
So, take a look at this. Does this setup ring a bell? You spot this crystal clear support, this demand zone on your chart. The price comes down, it taps it perfectly, and your heart starts pounding. You're thinking, this is it. This has got to be the perfect entry. You go ahead, you confidently smash that buy button, totally sure you've just nailed the absolute bottom.
And for a minute, you're a genius. The trade actually moves in your direction, maybe it even gets close to your take profit. You're feeling on top of the world. And then, bam! Out of nowhere, the market just completely reverses, it crashes right through your entry and smacks your stop loss. If this has happened to you, and let's be honest, it's happened to all of us, you are not alone. And there is a very specific reason why this happens.
Yeah, that whole frustrating experience, that's what we call the classic trading trap. And it's incredibly common, especially for traders who are making all their decisions based on just one single time frame. So let's really dig into why this keeps happening. You know, according to all the trading books, a demand zone is this magical area that's just packed with buy orders. So the standard play, the one we're all taught, is to buy the second the price touches the top of the zone, and then you stick a stop loss just a little bit below it. The logic, of course, is that all that buying pressure should be enough to send the price soaring.
But here's the catch. The theory sounds great, but the reality is that markets are basically designed to hunt for liquidity. And you know what that means? It means the price will often push just a little bit below those super obvious zones, specifically to trigger all those stop losses before, and only then moving in the direction you thought it would. It leaves so many traders holding the bag on what should have been a winning trade.
So how in the world do we avoid getting caught in this trap? Well, the secret is to completely change our perspective. Instead of looking at a street map of the market, we need to zoom all the way out and get the full satellite view. And that is the power of multi-time frame analysis.
Now, here's where it gets really interesting. Think of your time frames as having different jobs. The higher time frame, like the 1 hour or the 30-minute chart, that's your strategic map. It tells you where to even bother looking for a trade at those major demand levels. But the lower time frame, like the 1 minute or 5 minute, that's your tactical tool. It tells you when it's actually safe to pull the trigger. And this, right here, this is the absolute key to the whole thing. We never just blindly buy at a demand zone anymore. We are going to wait for the price to enter our high time frame zone, and then, and only then, do we drop down to a lower time frame to look for actual proof, for confirmation that the buyers are really stepping in and taking control of the market.
And one of the best forms of proof you can get comes right from the candles themselves. You see a reversal candle with that tiny little body and those long wicks? That thing is screaming indecision. It's a battle. But a continuation candle? Oh man, that big, bold candle with a powerful body and tiny wicks, that is pure conviction. That is the proof we're looking for. That signals a real shift in momentum is happening right now.
Okay, so let's put all these pieces together into a really clear, actionable blueprint. This is the 4-step confirmation strategy that you can literally start using today. All right, here is your roadmap. Step 1, find your key zone on a higher time frame. Let's say a 15-minute demand zone. Step 2, and this is the hardest part for most traders, you do absolutely nothing. You have to patiently wait for the price to come to you. Step 3, once the price finally enters your zone, now you zoom in, drop down to a lower time frame, like the 1-minute chart. And finally, step 4, this is where the magic happens. We look for confirmation. We wait for that little internal downtrend to break and shift in our favor. Once it does, we can enter on the brand new and much safer internal zone that this shift creates.
Now, theory is one thing, but let's see how this strategy actually performs in the wild. We're going to walk through 2 real-world examples, one on the S&P 500 and one on gold.
Okay, check this out. It illustrates the strategy perfectly. On the S&P 15-minute chart, we've got a clear uptrend pulling back to a demand zone, so we wait. Price enters the zone and boom, we drop to the 1-minute chart. What do we see? Well, that pullback is actually its own little mini downtrend. We just sit on our hands and wait for that internal downtrend to break. When it does, it creates what we call a market structure shift, meaning that little downtrend is now a little uptrend. That confirms a brand new, tiny 1-minute demand zone, and that is our precise, high probability, much safer entry point.
And guess what? The exact same logic works perfectly for selling, just in reverse.
On this gold 30-minute chart, a long uptrend finally gives up, shifting the market structure to bearish. Price then pulls back up into a supply zone. We wait for it to get there, then we drop to a lower time frame. And on that lower time frame, we can see the pullback is just a little internal uptrend. So we patiently wait for that little uptrend to fail and break down. That break is our confirmation. It validates our whole bearish idea and creates a fresh internal supply zone where we can now confidently enter a sell trade.
Okay, so let's just lay it all out side by side so it's crystal clear. For a buy setup, you're waiting for the price to hit a high time frame demand zone. Then you zoom in and you wait for that low time frame pullback, that little downtrend, to break and shift into an uptrend. Your entry trigger is that new internal demand zone that gets formed, and ideally it's confirmed with a big, powerful bullish continuation candle. For a sell, it's the perfect mirror opposite. Price hits a high time frame supply zone, and you wait for that little pullback uptrend on the low time frame to break down.
You know, what we've really been talking about here is so much more than just a setup. It's a fundamental shift in how you approach the markets. It's all about trading with patience and with precision, not just with hope.
So what are the big takeaways here? First, patience is your absolute greatest asset. You have to let the market come to you. Second, confirmation is everything. Stop trying to predict the future and start reacting to what the market is actually doing. Use those lower timeframes to get that clarity and find a much lower risk entry. Honestly, this one shift from predicting to reacting is the core of what separates amateurs from professionals.
And this quote just sums it all up perfectly. Our job is not to be a fortune teller. Our job is to identify the key areas on our map and then to react with a very clear plan when the price actually gets there. This strategy gives you that plan.
So the final question is really for you. Are you going to keep trading based on hope, just guessing that a level is going to hold? Or are you going to adopt a more disciplined, a more professional process and start waiting for confirmation? I can tell you that choice can make all the difference in the world.